How's it going, guys? Welcome back to another video. In today's video, what I'm going to do is I'm going to go through a more mechanical way that you can mark market structure. Now obviously I've done a video on this in the past and showed you how I used to mark market structure, and how I used to do it is basically by measuring the pip pullback. So for example, what I would do, say on the 4 hour, I'd use like a 40 pip pullback on, let's say, this pullback right here. As you can see, this pullback is around 100 pips, so for me this will qualify as a pullback. And then for example, I would then go ahead and measure this. Now while this method does work, and while it's quite kind of mechanical and it's quite easy to do, the problem with this is that the ATR changes, and what ATR stands for is average true range. So what average true range is, it's basically, you know, the volatility and the volume in the market. So one day you might see that this pullback right here measures, 100 pips, and then on another day it might look the exact same, but it might measure, 150 pips, maybe 200 pips. And this is where the measuring pip method actually, is detrimental to your trading, because the ATR changes very, very often, and you will notice this, especially if you trade, GBP USD. What you will notice now is that, the stop losses are now quite big. So this is one thing that you need to eliminate in your trading, and the way that I'm going to show you today is a little bit more mechanical, a little bit better, and it just keeps you more often than not on the right side of the market. So let's just see here. As you can see, we are on the 4 hour chart. So one thing I want to mention before I dive into the charts is, let's just say that we are in a bullish trend, right? And we are coming up, we're making high highs, higher lows. What often you might see is, you might see price come down, sweep this low here, and then at this point here you might think that we are going bearish, but in matter of fact what we're doing is we're taking liquidity below this low to continue towards the upside. So for me, one thing that I do take into account is, once we break down, I will look for a pullback and then a break of this low to confirm obviously a trend change. What you could do is you could obviously take trades from here, which they do play out and they are viable, and they're valid places to take trades from, because you've had this this first change of character. But this is a more risky entry point, and if you want to wait for a more confirmed way of showing that a trend has changed, you can wait for the second break of structure, which would be this one right here. Wait for price to pull back in sort of this supply area, and then for it to continue down, taking out all this internal range liquidity right here. And like I said before, you can take trades from this area, which is absolutely fine. It's entirely up to you. You can obviously test this, gather data on this, and see if it works more often than not on your given currency pair, or whatever you may be trading. So let's go down onto the charts now, and let me just explain kind of what we are going to be doing. So what we're going to be doing is we're going to be following 4 hour order flow, and then on the 15 minute it will be more 15-minute swing structure. And what you can do is you compare this with the daily and the 4 hour, the weekly and the daily, the 1 hour and the 5 minute, whatever it may be. You can take a look at it and see which one works for you. But for this example right here, I will be using the 4 hour and the 15 minute in order to show you how this works. So what we've got here is a push up, a pullback, and then a break. So if I just mark this out, so we've got a first break to the upside right here, and then we've got our break here, we've got a break, a small break right here, we've got a break to the downside right here, and this is what I've just been speaking about a moment ago. So we've broke to the upside, come back down, swept liquidity from below this low, and then we've continued bullish. So then we've got another break to the upside, we've got another break to the upside, and then we've got a break to the downside. And then here is where we do get a confirmation that this trend has then potentially changed, and we're potentially going to get lower prices. So we come down, get our pullback, and then get our second break of structure right here. So overall, this would be our 4 hour order flow. We've got a push up, a high, a higher low, higher high, higher low, and we've continued like this until we break down here, and then we get a pullback, and then a confirmation that we are, we're likely to get lower prices because of this second break of structure which has occurred at this point. So once I've marked out my 4 hour order flow, what I would do then is I will drop down on to the 15-minute chart. So once I drop to the 15-minute, obviously, as you can see, this is all obviously, internal stuff on the 15-minute, and this would be considered, all this stuff here would be considered 15-minute order flow, and the more outer stuff is 15-minute swing structure. So for me, when I'm applying my, premium and discount, it would be, let's say, from this low right here to this high. As you can see, price then pulls back into a discount. It then continues to the upside. So this is the overall way that I would mark it. And if I come down and just show you kind of how I would navigate price. So let's just say right here, right, what you can do if you are marking structure like this, what you can do then is once we get our shift to the downside. So we've got a shift here. So we've got a breakout structure to the downside right here. What you can do then is you can start looking to take trades down in towards the discount of this overall swing range. So if I just zoom out a little bit and just, mark our premium and discount on. So our premium and discount would be from this low to this high. As you can see, then price does come in. It actually does tap in to a discount. So it comes up and then it pulls back and taps perfectly into a discount. So let's just mark this out with this. So we've got this low, and then if we just bring it over, as you can see, it's tapped in to discount. It's tapped into this overall, demand range right here. So you could have had this marked out, and then it's come in, tapped into this, continued to the upside. What you could do is you could take trades, in this internal pullback leg here on the 4 hour. That's absolutely fine to do. You just need to bear in mind that these would be counter trend to the higher time frame and the overall 4 hour idea that we are playing. And the more high probable trades would be when we get our bullish shift. So for me, what I would do is I would personally wait for, price to mitigate something down into towards a discount right here. Once price has mitigated something within the discount, because what you will notice if you practice this on your charts is that obviously price will then pull back somewhere towards the discount. Once we tap into the discount area of the leg, what you can do then is anticipate a 4 hour bullish trend change. So this would occur right here. So we get a trend change right here, a change of character, whatever you want to call it, a bullish boss. What you can do then is you can start, anticipating moves from somewhere around here, somewhere around here. There's not really much, there's not really anything clear at the moment on this price leg specifically, but what you can do is you can then look to take trades from, anywhere around here up and towards this 4 hour high, which would be the expectation to be taken out. And let's just say that we are in a bullish trend. The next logical area of liquidity would be resting above these highs right here. So this is where the most logical area of liquidity is when we are in a bullish trend. You can take liquidity from below lows, which is absolutely fine. But, if we're in a bullish trend, the next logical place to take liquidity from would be, the highs. And then if we go up and look at the next, area of price, what you will notice is, if we come down somewhere down here, right? So we've come down with sweat liquidity. And what I said before is if we don't get a pullback and then a second breakout structure, you need to anticipate the likelihood is that we could continue bullish because, price does come down, take liquidity from below lows, and then it can continue up. And you will see this quite a lot, when you're going through and backtesting yourself. What you can do then is you can obviously again anticipate the bullish trend change, and then you can look to start getting involved into some sort of areas down here. You can take a trade somewhere down here. You've got somewhere around here, and then what you can do is you can literally follow order flow on the 15-minute up until take out this 4 hour high, which would be the obviously expectation to be taken out. So that's how I would personally go ahead and start marking market structure if you are struggling. It's a really mechanical and simple way to mark it. So for me personally, what I do is I mark it out like this, and then what I will do is I will literally start following 15-minute order flow. I would then take trades from, around here, and then I would get involved somewhere around here, and I would literally just follow price up on the 15-minute in order to take out this 4 hour high, keeping in mind that this is the most logical place that will next be taken. And literally what you can do is you can just follow this inside every single price range. As you can see, what we've got on this example right here, we've got our bullish shift. Price then pulls back in, it sweeps liquidity from below this low right here. It then continues up, it takes out this 4 hour high, and this is obviously what I've spoke about all the way through this video, and this is pretty much how the market moves. Obviously it's not always perfect, obviously it's not always going to pull back, but a lot of the time what you will notice is that it will pull back to some sort of demand area and then it will continue, and a lot of the time it will take out this unless it just doesn't want to, and obviously the trend then just change. So it's just that simple, guys. That's how I would go ahead about doing it. It's a really mechanical way, it's a really simple way to obviously follow price. It keeps you on the right side of the market more often than not, And yeah, that's pretty much it. If you have any questions, as always, feel free to drop them in the comment section down below. And without further ado guys, thank you very much for watching, and I will see you in the next one.